It's a special edition of Business Incorporated. Thank you for joining us. I am Bisi Adebayo. The Monetary Policy Committee of the Central Bank of Nigeria is set to announce its decision for the fifth MPC meeting in the year 2020 amid fears of escalating tensions arising from the spread of COVID-19, where several systemic central banks have been announcing various stimulus packages to whittle down the devastating effects of the virus. The CBN had also announced some stimulus packages since the start of the pandemic to support vulnerable sectors and stabilize the various macroeconomic fragilities that are developing off the back of the COVID-19 pandemic. Some analysts believe that most central banks in Africa will probably hold rates as inflation remains above target, while a recession in South Africa and muted price growth in Kenya make those nations outliers still considering rate cuts, although their room for maneuver is also narrowing. But let's take a look at some of the approaches central bankers in sub-Saharan African economies have taken recently. For example, in South Africa, the SARB decided to keep the repo rate on hold at 3.5% following its latest meeting last week. The Reserve Bank Governor, Leseja Kyango, also indicated that the repo rate cutting cycle may be well over this year, dashing hopes from some quarters that there could be one last 25 basis point cut at the MPC's final 2020 meeting set for November. Now, the Egyptian Central Bank is meeting on September the 24th, but at its last meeting in June, the bank left the main operation rate unchanged at 9.75%, and that was expected by most market analysts. Market watchers also expect the CBE to hold even as inflation is at its lowest in nearly a year. And elsewhere in Angola, the central bank hasn't cut its policy rate this year and is unlikely to do so. And that's even as the economy continues to face a triple shock from the virus, the oil price drop, and a reduction in crude oil output to meet its OPEC Plus commitments. The Monetary Policy Committee of the bank met in March 2020 and maintained the base interest rate at 15.5%. But the Monetary Policy Committee will hold its next meeting on September the 28th. And then in an emergency meeting in March, the Monetary Policy Committee of the Bank of Ghana slashed its key policy rate by 150 basis points to 14.50%. And analysts expect the central bank to probably keep its rate at an 8-year low for a third consecutive meeting, also on September the 28th, as inflation remains above target in August. Well, but back home here in Nigeria now, all eyes are on the central bank's announcement in about half an hour, where Governor Godwin Emefiele will be reeling out the key decisions at today's meeting. But then, what are these key macroeconomic indicators the MPC will have to consider as it makes its decisions, and what are the monetary policy responses so far? Well, to dissect some of the issues and set the tone for the announcement of the MPC decisions today, I have with me in the studio the Director General of the Lagos Chamber of Commerce and Industry, Dr. Muda Yusuf, the CEO of Capital Bancorp, Mr. Aigboje Higo, who joins us via Skype, and then in our Abuja studio, I have Dr. Magnus Kwako, who's the Chairman, CEO, Economic and Business Strategist Limited. I'd like to thank you for coming on the program. But just before we get to that, Temple Ashaju will be giving us details of some of the key macroeconomic indicators the MPC would have to look at the end of today's meeting. Over to you, Temple.
Yes, BC, great to actually have you on the show this afternoon. And of course, let's quickly review some of those decisions that the MPC, the CBN MPC took at the last meeting that they had in August. Of course, we know that quite a number of the metrics remained unchanged. Before we come to the macroeconomic picture in terms of the variables which we have here, we know that all of the MPR, the CRR remained at 27.5% and the MPR remained at 12.5%. And of course, all the other key metrics remained unchanged. But if you look at what has changed since the last time they had this meeting, for the Q2 2020 number moved downwards. We contracted by 6.10%. That's the GDP. And of course, that's some kind of a signal to what we are going to have for the rest of the year, because again, we understand that we're heading for some technical recession somewhat before the end of this year, perhaps this quarter or next quarter, but it's something that a lot of analysts believe will be some sort of a V-curve. Headline inflation, the last time, which is for August, it actually jumped by 40 basis points from 12.85% to 13.22%. External reserves, this is the latest number we had as at Monday, $36.2 billion. Let's look at what we have in the equities market. The picture still looks quite all right. 4.72% year to date as of yesterday. That's what we're doing in terms of the negative performance of the markets. And of course, Q2, quarter to date, we actually have a better picture. But then again, we still have the equity capitalization around 13 trillion naira. Look at the crude oil price, $41.58. This is what we had in early trades today. And of course, exchange rates, given the different spot rates that we have in the market, what we have for the spot rate is 379 naira per dollar, but we know that it's between 460, 465 at the parallel market, which is the streets market that is very, very accessible to everybody. MPC decision as of the last time they met, of course, all of these key metrics, as I mentioned earlier, remained unchanged. But let's look at some of the stimulus measures that the CBN had put out or announced since we had the COVID-19 pandemic. You know about the one-year moratorium. You know about the loan-to-deposit ratio policy that started in July 2019. And we understand that that has now contributed a lot to the loan book expansion that we've seen across the banking sector, and it continues to grow. There's a 50 billion naira target credit facility fund, which is made available for MSMEs. For those of you that have actually benefited from that, you know. Those that couldn't benefit, their application hasn't been successful, you know yourself. But you, of course, know about the 100 billion naira intervention facility that is targeted towards pharmaceutical companies and, of course, basically the healthcare space and other key players that you have in the healthcare area. We know of the research fund as well that is also supposed to be taken out of some of these facilities that we have. There's a 1 trillion naira facility for local manufacturing and production. That is something that some folks in the manufacturing industry have been able to apply for. For regulatory forbearance, of course, you had some loans before, the pre-pandemic period, and you have been seriously affected by the pandemic. You can actually apply to your bank and get all of these funds restructured. 23 billion naira COVID-19 fund from different companies, stakeholders that we have in the system. They put all that fund together for you to be able to get some access. Now, here's an update that the CBN gave about all of these gamut of funds that they put together as at the end of August. We understand that these funds have had a beneficiary status of 44,458 beneficiaries before now. Now, as at August, it had moved to 103,189. And of course, you know, we have the other measures that have been taken since this pandemic period. Has been the FX sales resumptions. There's been the reduction of interest rates on savings deposits, of course, because of the real market rates that we have. That's not too good for the banks. Then there's the prohibition of the Form M for buying agents and, of course, intermediaries. Then there's the restriction of FX for maize and, of course, fertilizers. There are several programs that the CBN has also put out under its development finance initiatives. You know some of them, the 200 billion naira housing fund. There's a 250 billion naira compressed CNG facility. There's a 500 billion naira solar connectivity facility. There's an agri-SME, agri-credit guaranteed fund of 50 billion naira. And we got an update on this particular initiative recently this morning that the maximum that one can actually apply for based on the collateral that you have is 50 million and 10 million naira. As that's reviewed from the 10 million naira, which the fund can actually make available before now. And of course, under the federal government programs, we have the Special Public Works Program and several other programs in the Youth Investment Fund, the Special Public Works Scheme, the 75 billion naira MSME Survivor Fund, and the Trader Money, Farmer Money, and all of the initiatives. And of course, the social investment programs that the federal government on the fiscal side of things have been able to put out for you to apply for. BC.
Thank you, Temple. All right, now let's continue the conversation. Earlier I mentioned that I have the Director General of the Lagos Chamber of Commerce and Industry, Dr. Muda Yusuf, right here with us in the studio. You're welcome to the program. And we also have the CEO of Capital Bancorp, Mr. Aigboje Higo, who joins us via Skype. And in our Abuja studio, I have Dr. Magnus Kwako, who's the Chairman, CEO of Economic and Business Strategists Limited. Thank you, gentlemen, for coming on the program. Well, let's begin the conversation in earnest with some of the factors and events expected to shape the decisions for this meeting. And I'm coming to you, Dr. Paku, for this one. Now, tell us, what are some of the global events that you expect the committee to put into consideration?
Yeah, well, I think that thank you very much to be on your show, the wonderful show. But I think that the main thing is that the economy appears to be caught in a vice. So we've got, on the one hand, you got a very sharp GDP decline in the second quarter, as you mentioned, 6.1% decline, and then you have inflation rising well over 13%, and so that puts the Monetary Policy Committee in a tight and difficult situation. So they're wondering, should we raise rates so that we can hold back inflation, or should we lower rates so that we can boost growth? So it's not an enviable position by any means to be in. I think that will be like the main thing that they're going to be looking at. Where do we go? And it's tricky to see what happens. Either way, they will have justification to do whatever they want to do. But the signs are there. With all the numbers you've also reeled out about the funds available to spend, I think there are some funds available to use to try to stimulate the economy, to get it to grow somewhat. So I think on that score, they may believe that they've got some resources to some extent. But the real problem is in the nature of the economy itself. And that is that the economy is at a point where, well, as you all know, we've always been dependent on crude oil prices. So the real fundamental problem is that we've not been able to grow at a steady pace. Since 2017, when we came out of recession, I don't remember any time where we grew anywhere upwards of 2.6% on a quarterly basis. So that's not a situation that we want to be in. If you're a developing country and you want to become a very well-respected emerging market, if you want investors to look at you as a place where something is happening, well, you need to be growing a little bit faster than that. And then even for Nigerians, a little bit restive of the different economic ailments they seem to be looking at, they want a much stronger pace of growth. And I think that these are the problems that they're going to be looking at. What do we do long term? What are the things that we're going to try to do? What signals do we give? The other thing is, and I think that the central bank should recognize that they are just one of the players. I think that unfortunately they have heaped on their heads this notion that they are going to be the party or the institution that brings economic salvation to the nation. And I think that that they need to be careful making people think that they are the only ones that can do that. But that said, they have been the main player in the game because the fiscal side has been handicapped by lack of revenue from crude oil and from non-oil resources. So it's left the central bank out there to play by itself. And I actually, we're waiting to see what happens. But I think the CBN has done a pretty good job using very unconventional methods. As you know, a monetary policy is blunt, especially in developing countries, because consumers don't rely on interest rates. Interest rates don't move consumers that much. If you want to go to the store to go buy something, you're going to have to pay outright for the most part. So interest rates don't move people that much. So whether you do whatever with the MPR, it doesn't really push the guy at the local market. I mean, so we're only looking at big players in that connection. And those big players, how do they really have connection with the main economy? So these are issues that we're going to wait to see what happens. We're going to look to the CBN to make their decisions, and we'll talk about them.
Thank you, Dr. Paku, for that. But please hold on to your thoughts. We'll be continuing the conversation in just a moment, talking about the special edition of Business Incorporated as we await the final decisions of the MPC meeting. Please stay with us. We'll be right back. Welcome back to a special edition of Business Incorporated, and I still have with me the Director General of the Lagos Chamber of Commerce and Industry, Dr. Muda Yusuf, here with me in the studio, and I also have the CEO of Capital Bancorp, Mr. Igboje Higo, and Dr. Magnus Paco, who is the Chairman, CEO, Economic and Business Strategist Limited. Well, thank you all for staying with us on the program. Now, Dr. Yusuf, let me come to you on this one now. At the last MPC meeting, where the MPR was left unchanged, central to the committee's decision was the rising inflation rate, of course, taking a look at the COVID-19 impacts, the devaluation for exchange rate measures, and the various fiscal and monetary interventions of government. But then, since the last meeting, we've seen a few more developments talking about the GDP contraction that outpaced the CBN expectations and other developments. So what for you are the priorities for the committee at this time?
Well, the priorities are how to stimulate the economy. Because we have seen the kind of numbers we had with the GDP performance in Q2, a contraction of about 6.1%. And there is some level of expectation that we are likely to go into recession by the third quarter of this year. So if you have that kind of scenario, a situation of looming recession, I think what we need to do, and what I expect the central bank to be looking at, is how to at least minimize the shock of the recession, so that we don't have the magnitude of recession or the magnitude of contraction that we had in Q2. We are likely to have a negative growth, but I think what we'll be looking at is how to reduce the degree of negative growth or the degree of contraction in GDP. Because normally inflation is an issue, but when you are faced with the kind of economic challenge that we are faced with now, we are talking about a looming recession, we are talking about high unemployment, we are talking about a whole lot of issues around investment. I think the focus should be on how to grow investment. And to grow investment is to ensure that we don't further contract some of these monetary policy variables. If you cannot relax them, you should not go and contract them anymore. From the figures that you read out, which was read by Tempo, you can see a whole lot of things that the CBN has been doing to stimulate the economy. But the economy is still where it is. Of course, the CBN alone cannot solve all the problem, but it's playing its own part. There has to be other complementary measures from the fiscal side. There also has to be some policy measures within the remit of the CBN itself, beyond issues of interest rates. You need to worry again about all the issues around foreign exchange management and all of that. All those things also have a very important role to play, in stimulating the economy. So what is paramount at this time is to stimulate the economy, to put in place policies that will help to expand growth and create more jobs in the economy.
All right. Now, I'm coming to you, Mr. Higo, for this one. Now, of course, we've seen that headline inflation has continued to creep upwards over the past 2 months, up 40 basis points in August alone. And food prices have been the main driver of the acceleration. But we cannot ignore the pickup in the core measure from a combination of the lockdown, the exchange rate adjustments, and general structural weaknesses. How has the private sector been mitigating the impacts of this spike?
Thank you, and thank you for having me on your show. It's not been easy for the private sector because, first of all, you are dealing with stuff in the economy. You are dealing with the pandemic. First of all, we had the health crisis. Now it's becoming an economic crisis. High unemployment rates, poverty rates. Now we also high inflation, electricity is going up, fuel prices are going up. So everything is happening at the same time. And it's difficult to juggle many balls. So I guess what most people are doing, they're just focusing on the things they can control. They're focusing on those areas where they have, they can make the highest impact, they can get the best of whatever limited resources that they have. That's what everybody is doing right now. Just focusing on those things you can affect and doing the best that you can and hoping that things will get better. Luckily for us, the health crisis hasn't gone away. The pandemic hasn't gone away, of course, but it appears to be abating. So hopefully as schools open, as other institutions that have been closed open, we'll see some semblance of economic activity. Some people can get back to work. Life can at least begin to look normal again. And hopefully that would bring its own positive impact on the economy, and that would also impact private sector firms. So it's a tough time, and it's likely to get tougher before it gets better. So we all need to brace up and get ready for tough times. But with the right policies, as some of the policies we're seeing now, if those policies are allowed to kick in and we're all united, and the CBN and everybody else, the government, they're doing all the things that they know that they should do and they can do, then hopefully the impact will not be as bad as it can be. And from 2021, we can hopefully begin to see some growth again.
Mr. Kpaho, let me come back to you with this. Now, of course, the CBN has been up with a raft of new guidelines and investigation into forex activities now. But do you think that this will help to stabilize the naira or then create more speculation in the market in the short to medium term?
Well, yeah, I think that the main problem with the naira is in connection with production and production for exports. I think, to the extent that we continue to rely on just crude oil, accounting for near 90% of exports, so 70% of government spending, we are going to keep finding ourselves in this quagmire. The gap between the official rate at about 381 or so, and even the investors' export window, and the parallel market rate, that gap, that's especially the gap between the parallel market rate at 465 and the official rate at 381, suggests that there is a serious issue, because most people, ordinary people, where they go to get their dollars, their foreign exchange, is in the so-called parallel market. So that tells us that there's a great amount of demand. Now, I had always been in support of giving some resources to some foreign exchange to bureau d'echange traders so people can access them. But we are seeing that basically what's happening is that it doesn't matter how much the central bank gives to them. There was a long period of time there where they did not give them these hard currencies. Now they are, and still the gap exists. So that means we have a fundamental problem. And I think that fundamental problem exists because our production capacity is not strong enough. If you say, as I mentioned earlier, that monetary policy that inflation is a monetary phenomenon, then you are caught in a tricky situation, in the sense that if you have inflation the way we have it, 16% food inflation, 13.5% or so the headline inflation, and then the growth is not there. You have negative growth taking place. What it means is that because inflation should suggest that the quantity that you have a more rapid increase in the quantity of money than the increase in the quantity of output. So if you have a more rapid increase in the quantity of money when the economy is down, and then still have this kind of inflation, it suggests that there are some fundamental supply constraints taking place. Are they temporary or are they permanent? And that's why I brought us to the past and saying that over the last several years, we have not been able to grow anywhere near 3%. So that means that's at the core of the issue with the exchange rate. You got to have something that you export to other people in order to get it. The exchange rate, what is it? It is the price of foreign currency.
All right,
so
Dr. Kpaho, we don't have much time. We need to just wrap up the conversation at this point, but we'd like to thank you for coming on the program, Director General of the LCCI, Dr. Muda Yusuf, the CEO of Capital Bancorp, Ms. Igweje Higo, and Dr. Magnus Kaku, who's the Chairman, CEO of Economic and Business Strategies Limited. Thank you for coming on the program. Of course, we'll still come back to you on the other side. But that said, on this special edition of Business Incorporated, thank you for watching. I'm BC Adebayo.